Since 1981, when interest rates topped out at about 15%, we've had a long march downward in interest rates, which has created an amazing storybook romance with bond investors. It's been a good 30 years to be bond investors. But like most good things, they all tend to come to an end. And like every bond caper, there's always a villain. There's always a villain in a bond caper. In Casino Royale, there was Shafir, or however you pronounce it. In Live and Let Die, there was Mr. Big. And we can't forget Dr. No. So what is the villain in fixed income investing, in this bond caper that we've been talking about? Well, many think this villain is rising interest rates. And we're going to tackle that today on the Retirement Answer Man Show. My name is Roger Whitney. I am your host. And this is the show dedicated to not just slaying villains, not just helping you survive retirement. We want to help you rock retirement. So we got a jam-packed show today. We have, in our practical planning segment, setting the stage for who this villain really might be, rising interest rates. And we have a chief strategist from a major investment firm to help set the stage and describe this villain. Let us know how evil it might be. And then in our practical planning segment, we are going to talk about the basic relationship of bonds in rising interest rates over time. So we got a lot to cover. It's going to be fun. But before we do any of that, you know what we need now? We need that all-important disclaimer. Another scary villain, maybe. No, the disclaimer is not a villain, but it is very important. It's one of those things we sort of overlook, sort of like the emergency card when you get on an airplane. So here's the deal. Don't take advice from me on this show. I don't know anything about you. You don't know much about me. Pretty much a good rule. Don't take advice from people that don't know you. And I can guarantee you I work really hard not to give advice to anyone I don't work for as a fiduciary. So make sure you take this as helpful hints and education. And before you make any decisions, talk to your legal advisor, your tax advisor, or your financial advisor. Now, we are talking investments today, and we're going to talk about indexes. So it's important you remember you can't actually invest in an index. It's just a model that someone comes up with, and many product providers create investment vehicles to try to mimic them. So remember that. Remember, different types of investment have different levels of risk. And lastly, but definitely not leastly, if that's even a word, past performance does not guarantee future results. Like that card in the airplane, you probably have read or heard that many times, and it's really easy to ignore. So I want to take a little sidebar here just to address that for a second. Now, intellectually, we get, when we look at past performance of some investment, that it happened in the past. Intellectually, we get it doesn't guarantee anything in the future. But you see, our minds play tricks on us. Because when we look at a fact sheet for an investment, and we see the past performance and all the other features and benefits surrounding past performance, even though intellectually we get it already happened, there's no guarantee it could happen in the future, we still see it like we are reading a feature card for like a refrigerator. If I buy the refrigerator, I get the ice maker, I get the water, I get the light that turns on. Even though intellectually we get that that's past performance, in our minds we think, subconsciously almost, that we're going to get that if we buy it. And that is definitely not the case. And a lot of time is spent, a lot of wasted money is spent not acknowledging that and dealing with that. So that's my sidebar. Now, let's get on to the hot topic segment and define who this bond villain might be. So the other day, Jamie Dimon, the CEO of JP Morgan, came out with his annual investor letter. Now, this is second only to Warren Buffett's annual letter in terms of popularity as far as being read and, the sage that people listen to. And in this letter, Mr. Dimon outlined that it's very reasonable to expect the 10-year Treasury bond, which is the benchmark people use for guiding interest rates. It's very reasonable to expect it to have a yield of about 4% pretty soon. He says with normal growth rate and about a 2% inflation, that is very reasonable. And I think the 10-year Treasury is around 3%, maybe a little lower today. So that means interest rates may be rising if Mr. Dimon is right. Now, he also said that if growth increases, if wages increase, if inflation increases, which he sort of said could happen, he says it's very possible that the Federal Reserve, the bank that sets benchmark interest rates from which everything else is derived, that the Federal Reserve and other central banks around the world may have to take more drastic action, meaning increase interest rates, than they currently anticipate. So he's like, hey, we could have interest rates rise much quicker than all of us are expecting if certain things happen. This could be a, at least short-term, big villain for bond investors. So to help us get some perspective of this villain, rising interest rates, and really define, well, how evil might this villain be, I want to invite on John Lynch, who is the Chief Investment Strategist for LPL Financial, who has a long history of very sound research and acumen in this area. And also, even though he's that geeky, he's actually a pretty cool guy. So let's have a conversation with John to set the landscape for this bond villain. So John, thank you for joining me.
Thank you, Roger.
Pretty honored. So we're trying to define interest rates and the change in winds that we've had from 30 years since 1981 of interest rates marching downward. It seems that we're in a upward trend. Where are we at in the interest rate environment and policy?
Sure. Well, I think it's important to recognize that you say 1981, and it's been a 37-year bull market in bonds. It had to end sometime, but I'm not convinced we're in a bear market for bonds yet. As you know, there is a income generation phase to the credit cycle where a lot of coupon clipping can go on. And I think that's exactly where we are now. So, given the fundamental support in the economy and decisions that our central bank and global central banks are making, I still think there's an opportunity for investors to participate, particularly in a diversified portfolio.
So the idea is that even though we may have ended the march downward, it doesn't mean it just goes straight back up as far as interest rates.
That's exactly right. Our new Fed chair, Jerome Powell, has stated his intentions very similar to those of Janet Yellen, the former Fed chair, that they will be very gradual in their interest rate tightening campaign. I think you're going to see them adhere to that. You also have the dynamic where the Fed has, built up quite an extensive balance sheet, and they're going to gradually unwind that by essentially selling or letting the bonds that they've purchased, let those securities mature.
Which is a much nicer way.
Roll-off.
Yeah, which is a whole different dynamic that we really haven't seen much in history. And the idea is by just letting them roll off rather than selling them, it doesn't impact the market near as much, I imagine. That's
right. It doesn't increase a panic selling dynamic, if you will, because if you have the world's largest central bank selling bonds, that obviously could force market interest rates to go up significantly higher at a faster rate by simply allowing maturing securities to roll off the balance sheet, no longer reinvesting those proceeds. That results in more of a gradual nudge higher. And then you have to factor that in with the economy, with what market interest rates are doing, deficit spending, things along those lines. So it's all consistent with their intent to be very gradual in this environment.
So we've had, I think since 2015, we've had 3 raises in short-term interest rates or the Fed funds rate. And last I read, they're projecting 3 total for this year. What makes the Fed raise rates? Why are they doing this now?
Well, the Fed has two mandates, official mandates. First mandate is to keep as full an employment situation as possible. The second mandate is to keep a lid on inflation. Over the last 8-9 years, the Fed has, essentially, purchased all these bonds, right? And what we've seen is that's artificially suppressed interest rates. So now they have to be mindful of any inflationary risk, right? Because that's always the bugaboo for fixed income investors, right? You don't want inflation to eat away at that fixed return. So consequently, that all kind of plays into, we have slower than historically average growth, but still growth. And in spite of the Fed's efforts over the last 8 or 9 years, we still don't have an inflation threat yet. You talk about the 3 potential rate hikes this year. The media and the headlines will suggest that it could potentially cripple the economy. And it's our contention that, the average for the overnight lending rate, the federal funds rate, over time has been 4.5%. Right now, we're 3 full percentage points below that. So we have a long way to go. So I think that's very much part of slightly higher growth, slightly higher inflation, consequently only a gradual interest rate tightening campaign.
So that's actually a really good point, because if we look back to 1981, back when Paul Volcker was trying to kill inflation because it was.
That's right.
And then really since 2008, which was an extreme from a historical standpoint, and then we just have over 37 years marched to the opposite extreme because of 2008 and everything that went on there of. The Fed has really been trying to promote some inflation and some movement by flooding the markets with cheap money and liquidity. Is that a fair statement?
That's exactly right, because inflation means growth, inflation means profits, inflation means higher incomes for people, and inflation means tax receipts to help pay for the response to the crisis. And you mentioned 1981. We did a study and kind of a cheeky chart several months back that had interest rates at an all-time high when Fed chair was Paul Volcker. And Paul Volcker was like 6'8". And then we had interest rates at an all-time low, and Janet Yellen was the chair, and she's 4'10". So your listeners will be very happy to know that Jerome Powell is an average-sized man, about 5'11", and consequently, we think you're going to see average interest rates under Jay Powell.
Well, of course. That makes total sense to me.
That's right.
And it's interesting how you say the headline says, these, you could call it 100% increase in interest rates, but we're coming from such a low, unusual, or it's almost normalization. We're just we're not even near getting back to what normal interest rates are if you look historically.
That's right. In school, we learned that X% of nothing is still nothing, right? So if interest rates go from 1 to 2, yes, that's a doubling. However, they're still more than, if you look at the 10-year Treasury, the market interest rate, 10-year Treasury is still below 3%, and historically it's been approaching 7% on average. So we still have a long way to go, and that's why I want investors to really keep that in mind, that it's going to be, absent periods of volatility in the markets where investors get scared and rates could shoot up. But if you look at the overall picture, again, for the economy and what the Fed's trying to tend to do, we see a very gradual increase.
So let's talk about the gradual increase to probably still on the low end of normal, ultimately. Mm-hmm. What does that mean for someone that holds not individual bonds, but portfolios that hold bonds in terms of performance? You mentioned clipping coupons. Does it also imply a headwind in terms of you're not going to enjoy any appreciation anymore because we're not having these, the downward slope?
Well, that's why we want to make sure we emphasize the portfolio approach, right? Because there's a lot of discourse out there now suggesting that the bull market in bonds is over, which is why I made that comment earlier about the income generation phase or the coupon clipping type phase of the credit cycle, because we're strong advocates that bonds still can play an important aspect in a portfolio, right? The 10-year Treasury, even though the yield has climbed higher over the past 6 months or so, 9 months, it's still historically low when you look at longer term numbers and you look comparatively to interest rates throughout the world. So, an investor domestically may feel that our benchmark 10-year Treasury may be expensive, and it could still be viewed to historical averages, but it's exceedingly cheap relative to, if you look at similar benchmark offerings in Japan or in Germany, for example, two of the other leading global bond markets. So I think that's something to keep in mind also, that relative valuation is important. And when you look within a portfolio, Treasuries, for example, provide income. They provide a source of balance. They provide liquidity. And they can also smooth out volatility during periods of equity market tension, if you will, turbulence.
So I don't know if you can address this or not, and if not, that's okay. Obviously, you have to have a long-term perspective when you're building a portfolio, but we're humans, right? And
absolutely.
If we look at the Barclays aggregate index, now I still call it the Lehman. I can't. That shows my age, I guess.
I'm still there too. And now it's Bloomberg Barclays.
I can't keep up.
They changed it yet again.
I can't keep up. Wait, so when someone looks at that, and if they understand the idea of duration, and we look at the Barclays, the whatever aggregate index, and it has a duration of say 6 and has a yield of about 2.7. Even just if the rule of thumb with duration holds, 1% increase in interest rate would mean you'd lose about 6% of the value. Is that just, whether that's true or not, you're welcome to argue that, but is that just sort of like anything, just part of the adjustments that happen when you're investing long term?
Absolutely. And that's why, again, argument for diversified portfolios. And your point on duration is absolutely right. That's the rule of thumb. And for your listeners, the duration is basically a geeky term for how investors or analysts or strategists can identify the interest rate sensitivity of a bond holding. Say, if the Fed does this, what does that bond do? So, in this environment, as the Fed is gradually raising, we are positioning our fixed income portfolios for all our clients to be a little less on duration or interest rate sensitivity risk and a little higher on credit risk. So, for example, maybe a little less on treasuries because U.S. Treasury bonds they're the benchmark, right? So they have duration risk. Yet, if you look at some of the leading investment grade bonds, if you will, even to some degree, high yield. I don't want people necessarily pursuing junk at this point in the cycle, but as close to investment grade as possible, take on a little extra credit risk. I think a portfolio can benefit, as we've shown historically.
Yeah, in the next segment of this show, we'll get a little geek on, and explain duration a little bit more. And then next week, we're going to talk about some of the gadgets Q can bring to manage through just a changing environment.
Oh, good. That'll be very helpful. Yep.
So from a portfolio perspective, would you agree in the future, just simply because of where interest rates are and the landscape? And it's sort of a good thing, right? This is happening because things are getting better economically.
You are so right there, because when we were in a period, when the Federal Reserve was essentially printing money, now they get sensitive about that because they were creating electronic reserves. They weren't printing money. So we have to be very clear about that. However, nonetheless, it's basically synonymous terms. When they were doing that, it was almost as though bad news became good news. I'm sure you're familiar and your listeners are familiar with that term, right? Because bad news was good news, meaning there was bad economic news. That meant the Federal Reserve would keep cutting interest rates or keep printing money, and that would fuel the equity market and risk assets higher. Now we're in a situation where good news should be determined and should be viewed as good news, because if there is some inflation, that means the economy is growing, and if the Fed feels the need to gradually raise interest rates, the attempt there is to elongate the expansion and not cripple it.
Exactly. And when I think of inflation or growth rates, I think of a cocktail. I don't know if this makes sense. You tell me if this makes sense, John. So having one cocktail is good, but you just don't want to have too many. And it's like with inflation. You want inflation, you just don't want too much of it. And that's part of the role of the Fed, is to manage.
As in all things in life, moderation is key, right?
Exactly. Whether it's cocktails or inflation.
Or monetary policy.
Or monetary policy. So really, we're just hopefully just on the a path back to normal, but it causes short-term disruptions in headline news.
Exactly. And, for example, 6 weeks ago or so, we saw a bad wage inflation number. Again, a bad wage inflation number. Year-over-year wage growth was 2.9% on the original print for January. It was supposed to be, forecast was for 2.6%. So investors got blindsided by that strength, and they were overwhelmed with the fact that inflation was going to be a runaway threat because wages represent 70% of business costs. So they were, that's why we saw that major market sell-off in early February. And then the number was revised down to what has basically been average for the past several years. So as a result of all that, we're going to have periods where market interest rates may shoot up given concerns relative to deficit spending, wage inflation. But I think over the course of 2018, you're going to see just consistently higher, gradually higher inflation readings, economic growth readings, and consequently, the Fed will raise rates accordingly, not at a threatening level. So we're going to see spikes. In fact, we think we could see the 10-year Treasury yielding as high as 3.25% at different times during 2018, by the end of 2018. But, the range is still within 2.75% to 3.25% we view as fair value for the 10-year, given all the macro fundamentals that we analyze.
And you make a really good point there. Let's talk about that wage inflation number, which came out, which I'm guessing a lot of people don't pay attention to, but they see the headline in the article. What we forget is we were begging for wages not to be stagnant forever, which they have been. And then as wages start to grow, which means people get more money in earnings, all of a sudden we freak out. So I guess a lot of this is, if you think of like an airplane and you're flying, you're just trying to get to a destination. But when that bump happens, the turbulence, it can be scary, but it really doesn't mean anything long term. And I think that's some of what we go through in this period of change is it's a lot of headline news that if you're really a long-term investor and you have sound strategies, it's going to be a little bit of turbulence and then you earn more, hopefully, in coupons.
Simply tighten your seatbelt and raise your tray table during turbulence. That's all you got to do.
And if you're in first class, get a cocktail.
That's right. Moderation,
right. John, thanks so much for sharing some of your perspective. Any last thoughts you want to share on where we're at from an interest rate environment?
Well, first off, Roger, I want to thank you. It's been an absolute pleasure. It's great partnering with you. And parting shot for your listeners is just to make sure you're in a diversified portfolio. Recognize that we've been in a very unique period of low volatility when the Federal Reserve and global central banks were kind of suppressing short-term interest rates, and now market rates are going to adjust gradually. And I think that's really the key for everyone to appreciate.
It's been a joy, John. Thank you.
Thanks, Roger. Take care.
So maybe in the scheme of things, rising interest rates isn't quite the world destroyer villain, just like in Bond movies, they're not the end of James Bond. So in the practical planning segment, though, what I would like to do is talk about some bond basics so you understand the relationship that bonds have with interest rates, because bond prices in the short midterm do move based on what the Federal Reserve does with interest rates and what general interest rates are in the market. So this is an issue or a topic that you need to understand as a bond investor. So let's talk about the relationship between bonds and bond prices. It is something that's inverse, meaning that as interest rates move up, the value of a bond or a bond portfolio moves down. So why is that? Why would rising interest rates make the value of a bond or a bond portfolio go down? Best way to do this is to use an example. So let's assume you have a bond. You buy a bond for $1,000 from a company. We'll call it Retirement Answer Man Enterprises, RAM Enterprises. So you buy a bond, it has a par value of $1,000. And in return for lending the money to RAM Enterprises, RAM pays you 7% coupon rate or income for the right to borrow your money, to thank you for borrowing your money. So you would get what? You would get $70 per year in interest until the bond matured, until you got the money that you lent back from RAM Enterprises. So $1,000, you get 7% yield or $70 a year in interest. And you do that, say, January 1st of this year. Now, fast forward a year from now, and let's say general interest rates have moved up because the Fed has raised interest rates. And RAM Enterprises is now issuing bonds at 8% interest. They borrow $1,000, they have to pay $80 a year for every $1,000 they borrow, because that's where the prevailing markets say they have to pay. So what happens to the bond that you already own that is only paying $70 a year? You lent $1,000 to RAM Enterprises for that, and you got $70 a year. Now RAM is paying $80 a year for every $1,000 they borrow. Your bond in this case can't be worth the same amount of money because nobody's going to buy it from you for $1,000, what you paid for it, because they can go get a brand new one that pays 8%. So what happens is the value of your bond goes down, and I think mathematically it works out to about $875, and some of this depends on maturity. We're trying to simplify this in order to equate getting that $80, not the $70 per year. So the bond value would go down to the mathematical level that would equalize what the current interest rate or payments the person is receiving for, in this case, identical bonds with same maturities. And it's very simple. It's just how markets work. If there's a better deal out there, whoever had the old deal will have to compensate in the value of what they owned if they were going to try to sell it. That's why we have this inverse relationship. Now, there are lots of other factors in there. Bonds with lower coupons or amounts of interest that they're paying will be more volatile and sensitive to price movements because of interest rate changes. Bonds with longer maturities, meaning that, RAM Enterprises didn't just borrow the money for 2 years, they borrowed it for 20 years. Well, that will make the bond more sensitive to interest rate moves. And on a very high level, this is why interest rates are considered, at least in the short midterm, quote unquote, bad for bond prices. Because if interest rates rise, the same company will be lending money at a higher rate of return. So if you hold the old vintage, your price of your old vintage has to adjust because that's what markets demand. So that is one reason people think of rising interest rates as a bond villain. And as John and I talked about, that is usually in the interim when the adjustments are going on. It's not something that happens ongoing. Usually it's an adjustment because eventually that older vintage bond will pay you the interest that it promised and then return you your principal. And then you'll have the opportunity to go back and invest in the newest vintage at whatever the prevailing interest rates are. Makes sense, right? The difficulty comes in is if you have a bond and you try to sell it in this environment, you're going to potentially lose money because you have to sell it for a lot less than you bought it for, depending on interest rate moves. So that could be unfortunate. Or when you see it priced on your statements, whether it's a bond or a bond portfolio, and interest rates are rising, you'll see the value that are indicated on your account statements as going down, like you're losing money in the portfolio or in the bond, but it's still paying you the interest from whatever that portfolio or bond has, but on paper, it can look bad. So now I want to go to the geeky term that John and I mentioned called duration, which is an indicator to give you an idea of, well, how sensitive is my bond or is my portfolio? We're going to talk about portfolios because with a bond, there is this, you can use it for duration, but you always have the option to hold it to maturity. So let's just talk about portfolio bonds. What is duration? Well, duration is a mathematical formula, which is an indicator of the complex value of a bond based on its coupon and its maturity, because you get cash flows in a consistent way. And then ultimately, the ultimate cash flow is getting your money back. So it's the amount of time an investor would have to receive the coupon payments and the principal back in a bond. So you don't need to understand the mathematics behind it. What I think you need to understand, or at least understand, is what a useful tool it is to measure the interest rate risk or volatility that a particular bond portfolio might have. So let's take, I guess it's the Bloomberg Barclays U.S. Aggregate Bond Index. Man, how many words do you need? So this is the benchmark index that most people use when they're thinking of the bond market. And this is the benchmark that most investment vehicles like mutual funds, etc., ETFs and things like that try to mimic when you buy an index fund of some sort. So the Barclays, I'm just going to call it the Barclays Aggregate, okay? Barclays Aggregate has a SEC 30-day yield of 2.78%. So that means for every $1,000 you put into it, you theoretically get a yield, or you get $27.80 per year for that $1,000. That's the yield on the entire portfolio. So if you look at the portfolio, which are thousands of different bonds, the weighted maturity, meaning how long until technically those bonds would pay back the principal that was lent to them if they were held to maturity, is about a little over 8 years. So the duration, sometimes, there's other different ways of looking at duration. There's modified duration. We're using the term effective duration because that's what you'll see typically in a Morningstar or something like that. And that is the effective duration for the Barclays Aggregate is 5.91 years. So the rule of thumb is, and John confirmed it, it's something that's generally accepted by bond managers and investors the world over, is that for every 1% move in interest rates, the value of a bond portfolio, all things else being equal, would move by the amount of its duration. So as an example, if interest rates are at 3% and they go to 4%, they go up by 1%, the rule with duration would be means the value of the portfolio would go down by the amount of its duration, meaning it would go down by about 5.9%. So this is something that a lot of us are all sensitive to, because if we're an index investor or investing in something that mimics an index, wow, we're going to get a 2 3/4-ish yield. We're expecting interest rates to go up. And if they go up by 1% in the Barclays aggregate index, we're going to lose almost 6% of our money. Why would I do that? And that's what a lot of investors are worried about when they are allocating or adding this bond component to the cocktail of the asset allocation that someone has. So if we have, a lot of people get worried about runaway increases in inflation. Well, what if we have, we're so far below the normal long-term yields of most bonds because of this unique period that we came into that, wow, what if we have a 3% increase and we get back not even close to normal or almost close to normal, 3% move? Well, that's 6, roughly the duration. That's 6 times 3. We're going to lose 18% in our bonds. And that could happen if the interest rate increases happen really, really quickly. Now, if you're a long-term investor, over time, those will all work out because the portfolio is constantly buying and selling bonds to mimic the index. So it's a little bit of market timing if you're thinking of, really radically changing your investment in your bond portion. It's market timing, no different than it is in equities if you're thinking of selling because you think the market's high. So that is some basics of the interrelationship of bonds and where interest rate policy is. Now, next week, where we will conclude our series, we are going to we're going to bring Q in. Remember Q in the Bond movies? Q had all the cool gadgets, and John referenced a few of them. We're going to talk about what are some ways to not necessarily market time, but to be a little bit flexible to try to mitigate some of the dangers of this short-term disruption that might happen as we slowly work back to normalizing interest rates, which in the long term is good because it means the world's getting a little bit more normal again. So that's what we're going to do next week. But right now, after all this geekdom, we're going to go talk to Nicole and get happy and find out who her favorite Bond villain is. Hey, welcome to the Happy Lab. Now, in this Happy Lab, we're actually going to talk about villains. That's a weird juxtaposition. But Nicole, who is joining me after, again, sidestepping all the deep talk about bonds, very well done. Nicole, what is your favorite villain, if that's a weird way to ask it, I guess? But what's your favorite villain?
That is not a weird question. I have a favorite villain. Maybe I'm weird.
Okay, what's your favorite villain?
Magneto from X-Men is my favorite villain.
Why is that?
Because he's so conflicted and I can kind of understand why he's bad and relate to him. And it's sort of like a Hannibal Lecter thing, right?
No.
No?
No.
You never had yourself a little bit no. Okay. Anyway, who's yours?
Well, my knee jerk is you because I'm worried about you, but you're obviously not a villain. So how do we make this into a happy lab when we're talking about villains? What is it that makes someone have a favorite villain?
That's a good question. I feel like people do, though. I mean, even look at Despicable Me. It's a whole movie series where he's bad and then he turns good. I think a villain with redemption possibilities is something that makes...
Because we all feel like we have little areas that we need redemption ourselves, maybe?
Maybe.
Okay.
Maybe.
All right. I don't know how this works as a happy lab, but we're going with it. All right. Let's get on to the smart sprint.
You don't have a villain? Really?
On your marks, get set.
Okay, welcome to the Smart Sprint segment where we actually get serious about setting a 7-day goal, a little baby step to help you not just create a better retirement, but a better life. So here's what I would like you to do in the next 7 days. Go look at where your cash reserves are held, maybe at your savings account, your emergency fund. Get an idea of what interest rate you're getting. Because one benefit from these rising interest rates is that there are money markets and savings accounts that are yielding, wait, listen to this, 1.5% and sometimes more. I know.
That's actually high to me.
Well, that's, I grew up in the age of high money markets in the 6 and the 7%. But, money markets, the same money markets are yielding 1.5-ish% right now. At one point, we're like 0.25%. So in the next 7 days, evaluate where you keep your cash reserves so you're not leaving free money on the table. Nicole, there's one thing that we are not very good at doing on the show.
What's that?
Well, we have an amazing family here, and we would love to grow the family, so we don't ask people to share the podcast.
I don't know if we've ever asked people to do that.
Yeah, and I'm guessing you know people that are like you, and you seem to enjoy the show because you're still here, right? That would probably enjoy and get some value from not just surviving retirement, but figuring out how to rock retirement. So if you're so moved, share this show with a friend so we can bring more into the fold, because that's going to make us all a lot smarter. Have a great day.
We appreciate you joining us today for this episode of Retirement Answer Man. Be sure to visit rogerwhitney.com/answers to access the Retirement Answer Library with over 30 checklists to help you make the most of the only life you have. Remember, you have more power than you realize to create an amazing life starting today with Retirement Answer Man. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and no guarantee of future results. All indices are unmanaged and may not be invested into directly. Have a wonderful day.